Hello and welcome to The Upside. I'm Jordan Chevalier. Despite external pressures, both the U.S. Federal Reserve and the Bank of Canada announced rate pauses in January. So how have equity markets responded? And are we still on track for cuts to arrive both in Canada and in the U.S. later in the year? Joining the show today to take us through these key questions and highlight how they're shaping asset allocation is institutional portfolio manager and member of Fidelity's global asset allocation team, Ilan Kolet. Ilan and his team oversee roughly half of Fidelity Canada's $340 billion in assets, which includes some very popular product suites like the Fidelity Managed Portfolios and Fidelity Private Pools. Ilan, thank you for being here today.
Yeah, great to see you, Jordan.
So first up, let's focus on the Fed. I think it's fair to say that despite external pressures that Chair Powell was facing, he decided that it was best to hold rates. Take us through your thoughts.
Yeah, I mean, this was absolutely the right decision to make, right? So the Fed's goal, again, is to take incoming information on inflation, which has fallen substantially since its peak. It's not exactly where they'd like it, and signals on the labor market, which again is not amazing, but not awful, right? Sort of not unlike I say not unlike a meal on an airplane. And take those two bits of information and set monetary policy with an eye towards growth, economic stability, the labor market, and inflation. And it was absolutely the right decision to make, I believe, to remain on hold and pause, any further interest rate cuts or hikes, for that matter, based on the data. The much more concerning thing, as you alluded to, is political interference in the Federal Reserve and monetary policy making. And let's not sugarcoat it, right? This is, a serious investigation into the chair, into other members of the Fed board, political appointees, right? So this is not what you want to see. Between myself, David Tulk, and David Wolf, we have about 20 years of combined experience at the Bank of Canada. And the separation between the political function of government and monetary policy is very deliberate, and that's becoming a blurred line in the U.S.
Well, that's very helpful. I think if you look online, you'll see a lot of people predicting a couple rate cuts down the line. What are your thoughts on rate cuts? We'll stay on the U.S., but also your thoughts on Canada as well over the next 2 or 3 decisions. Yeah,
so I would say, in my assessment, both the Fed and even the Bank of Canada are likely on hold for some time, right? And that's because there's a tremendous amount of uncertainty right now, right? So we have trade uncertainty, policy uncertainty, interference in monetary policy, the functioning of monetary policy, and layer on that geopolitical uncertainty and volatility as well. Sometimes no decision is the best decision, right? And no decision is not no decision. No decision is we've examined the flow of incoming information since the last time we've met, and we've determined that the best stance for monetary policy right now is to remain data dependent and to keep things where they are, right? Given the flow of incoming information. Again, I always like to say, central banks don't have some magical set of data that we don't have. They're looking at the same Bloomberg screens you and I are looking at and assessing the economy versus their baseline and making the best decision they can for the future of employment, inflation, growth, et cetera. And so, there are market probabilities and forecasters who say, I think the next rate cut or rate hike is going to be here or there. I would generally sort of fade any table-pounding accuracy in rate decisions that are, towards the end of this year. We don't know, right? As the landscape changes, so do the central bank forecasts, and so do the base cases for those interest rate decisions. But right now, the data-dependent sort of hold steady approach is the right approach to take.
And from an investor lens, are there things investors should be looking at? Maybe not exactly, is it going to be a pause or is it going to be a cut? Are there other factors around these sort of decisions that investors can be looking at?
Yeah, so I mean, honestly, when I talk about central bank decisions to clients across the country, I always mention the framework that we should be thinking about when we examine a central bank decision is much simpler than what's presented to us sometimes in the ink spilled or the experts on TV. we should handcuff ourselves to two variables, right? So we should, and I talked about this at the start, we should think about inflation and we should think about unemployment. Inflation, again, it was exceptionally high, right? A few years ago, it has come down, it has moderated. It is roughly in the neighborhood of where central banks would want it to be. Again, inflation measures the rate of change in the price, not the price level itself. And the rate of change in the price, the growth rate of prices now, is in the neighborhood of where central banks would want it to be. So call that a check mark, or maybe in pencil. And the other one is the labor market. And again, the labor market in both Canada and the US is okay, right? So unemployment rates in Canada were somewhat elevated. They have fallen. It looks like Canada job growth is sort of coming back now a little bit since maybe Q2 of last year. And in the US, we have had declining rates of job growth on a monthly basis, but we shouldn't expect the rate of job growth and the unemployment rate we had 3 years ago, right? There is a break even that will get successively lower. There's a lot underneath that as well with population changes and stuff. But again, if you look at inflation and you look at unemployment, again, the two most important factors for a central bank and a central bank decision, it indicates that the right stance right now is to kind of stay where things are, take that data-dependent approach.
Ilan, you mentioned Canada, so let's focus in on that. Canada also held rates at 2.25%, and I'm going to quote Bank of Canada Governor Tiff Macklem, saying that there is unusual potential for a new shock, a new disruption. Geopolitical risks are elevated. Take us through your thoughts.
So Tiff Macklem, what he said was, and again, Tiff is a fantastic governor. I actually know him from way back when myself, David Tulk, and David Wolf all worked at the BOC. He's a fantastic leader, great governor. The way to think about that is a central bank has to assess what's called the balance of risks. Right? There are upside risks. If there had been a tax cut, okay, that's going to induce more spending. That spending could induce a little bit more inflation. That's not the case right now. And then the downside risks, right? And downside risks, I would say, as economists, it's something we generally focus on, more and more, right? If the joke is an economist sees a glass half full as a quarter full, right? So, truly the dismal scientists. And I would say geopolitical risk is one of the things on the list of risks that he was absolutely correct in highlighting, right? So geopolitical risks, whether it be the ongoing conflict in Russia, Ukraine, right? What's happening in the Middle East, what's happening with government change in Venezuela, right? There's no shortage of these things on the list. It's worth highlighting, it's worth recognizing. And for an economy like Canada, a small open economy like Canada, we are a taker of this volatility, right? We have to sort of deal with it. The other thing Governor Macklem rightly pointed out, I think this was in the press conference, was interference with monetary policy and attacks against Chair Powell, right? Which are, in my view, unforgivable,
right,
and seriously problematic. There are not strong enough words that I can express, well, especially not on a video, to indicate how problematic attacks on central banks are, right? So, again, there's a and Governor Macklem did a good job explaining why the government and monetary policy, the central government and monetary policy are two separate and distinct functions. And I'm paraphrasing here, but oftentimes the central bank has to make difficult decisions, that may not be the most popular in the eyes of the sitting government, but the reason you have to make that decision is because of the damaging effects of inflation, right? So for investors on this call, everyone should understand very well the damaging effects of inflation, right? Everything is much more expensive than it was 5 years ago, right? Inflation is a punitive tax, and for investors, which are listening as well, inflation and inflation volatility messes up that correlation between stocks and bonds that we know and love, right? And for that reason, we have to diversify and own asset classes like gold.
Ilan, that's very helpful, thank you. So we've covered the latest rate decisions. I want to dig now into the latest paper from the GAA team. It's called 5 Questions into 2026. I want to pull a couple of those questions out and we can kind of do a little bit of a deeper dive.
Yep.
The first one, and it's the first question in the paper, is AI a bubble? It's the question I think we're getting more often than any other question now. So
Right.
Are we in a bubble? Is AI a bubble? What are your thoughts?
Yeah, I mean, I joked on stage recently. The first rule of AI is always talk about AI.
Right.
So you have to. It feels like it's the only subject. I spent a lot of time on the road speaking to advisors coast to coast, and last year, the reason this is the first question in the paper is this was the number one question I was getting last year. We don't view AI as a bubble, right? So, and the reason for that is we have a 4-pillar investment process: macro, valuation, sentiment, and bottom up. Macro, we just spent a lot of time discussing, but bottom up, what that refers to is we consume the research that supports our underlying building block portfolio managers, and we speak to our underlying portfolio managers very often, right? The Mark Schmales and the Will Danoffs and the Hugo Lavallées and the Dan Duponts. We speak to them often, and what our company analysts are seeing is, really significant earnings potential from these underlying AI names, and so we want to participate in that, right? And what that means for us is, while we're leaning slightly away from the U.S., we want to maintain fully invested with managers like Will Danoff and Mark Schmale, who can beat their very difficult to beat benchmarks and buy not just AI names, but the right AI names, right? And that if they beat their benchmarks and we own them, they boost the performance of our fund, right? So for right now, our answer is no.
Okay.
A much harder question to answer is, what are the secular longer-term implications of AI? Are we going to be holograms in a couple of years? Right. A much more difficult question to answer, which we can answer another day.
Next video. And next question, you mentioned there's some political risk and some tailwinds in Canada, but still the team remains optimistic. Can you take us through that?
Yeah, I mean, again, this is one, when I'm on the road, you sort of read the crowd. This is one where there are a few eyebrows raised.
Okay.
And the reason for that is we're so used to an underperforming Canada, right? From 2014 to 2024, we were overweight the US and underweight Canada. And what that means is we were leaning into the US, sourced from leaning away from Canadian equities. That was absolutely the right decision to make. Our fund, performed exceptionally well over that. Our main fund performed exceptionally well over that period. But we have a view that perhaps the worst is behind us in Canada. Again, we think Q2 of last year was likely the bottom. Q2 was the quarter in which we saw an enormous decline in exports right after Liberation Day. Consumer confidence and small business confidence fell off a cliff. Canadians had just gone through this really brutal mortgage reset cycle. And again, the way that we think about things in Canada is maybe things are darkest before the dawn, right? So we have to, as asset allocators, we have to be thinking about where things are heading, not where things are right now. And we believe in Canada, things are priced for very bad when in fact, we might be heading towards less bad. There's probably a nicer way for me to say that, but again, the trajectory is what we have to examine. And so now we are cautiously optimistic and neutral Canada. We're not leaning in, we're not leaning away. We're neutral on Canada, and that's the and the last thing to mention there is, I would say we're sort of cautiously optimistic on the direction of fiscal policy towards, infrastructure and productivity and growth inducing projects instead of just building condos and selling condos to our friends, which is what we've done for the last 15 years, which is highly unproductive.
Right. So if anyone wants the full range of questions, that paper is available on fidelity.ca. It's on the homepage there in English and French for the full 5-question suite. We have a couple questions from the audience now.
Sure.
So one of them is, has this recession talk, it's died down a little bit. Is that still something on your horizon? How are we thinking about a recession in the US and in Canada?
Yeah, I mean, as economists, I would say, myself, David Wolf, David Tulk, we're always on the lookout for recession risk. But it speaks to why we have a really strong, that 4-pillar process that I've mentioned a few times, macro, bottom-up, valuation, sentiment. From the macro side of things, we work very closely with our asset allocation research team. They have recession probability models. Recession risk, according to them, in the US remains fairly low. It's kind of drifted slightly higher recently, but still remains very low. That drift higher is because of a generally weakening labor market, but certainly not troublesome. The more interesting development is recession risk in Canada has actually declined really meaningfully. So we were probably in or close to a recession in Canada for a couple of years, 2022
Right.
to 24, right? Somewhere in there. I mean, we weren't getting declines in growth, but a whole bunch of quarters of bad growth is just as damaging, or can be just as damaging. Recession risk in Canada, according to our internal models, has declined really significantly, which goes a long way in explaining that sort of cautious optimism that we have.
Okay, Ilan, thank you very much. And the last question here today, gold.
Yeah.
It's the other, I think AI is probably the hottest topic. Number 2 is gold. How does your team manage gold, and are there things, sort of structurally within gold as a commodity that you think will maintain through 2026?
Right.
Yeah.
So, yeah, the dad joke is gold is taking the shine away from AI.
Okay.
I promise not to make that on camera. With the gold discussion, if you ask me what's the best way to hedge inflation and inflation volatility, the answer is gold.
Okay.
What's the best way to hedge elevated geopolitical risk? The answer is gold. If you ask me if the attacks on central banks and monetary policy are kind of dollar debasement and a weak US dollar policy, what's the best way to hedge that? You guessed it, the answer is gold. There's a number of reasons why we want to hold gold. It's an important position for us in the portfolio. So we do have an out of benchmark allocation to gold, and on a look-through basis, that even adds more to gold. So gold is a very important position for us that we've held for quite a while. It's been an important source of return, but the thing with gold is you need to size that position effectively because of its volatility, right? So again, a very important position for us, and it's a high conviction position for us, but we're comfortable with the size of where we are at in the portfolios.
Ilan, that's a great place to leave it. Thanks again for joining the show today.
Super, thanks.
Thank you all for watching. Upside webcasts air daily, so keep an eye on your inbox to receive your invitation to the next show. And you can view our full Upside video library on Fidelity Canada's YouTube channel. And if you haven't done so already, sign up for the Upside newsletter to receive the latest updates. Also, video podcasts are released frequently, both the Upside and Fidelity Connects. Just search Fidelity Canada on YouTube, Spotify, and Apple Podcasts. Thanks again for watching. I hope you'll join us again on the Upside.